What's up, viewers? Thanks for dropping by. In our last episode, we talked about how we wanted to sell a put contract for ticker symbol LABU at the strike price of $6.50, and we were looking at a put contract that would expire today, the 3rd of March 2023. In today's episode, we will discuss what actually happened when we executed this trade and what the possible outcomes we could see by close of play today with this contract. And we would then be able to make a decision as to what the next steps should be based on the possible outcomes from the close of play today. You do want to stick around to the end of the video as we will be talking about 5 other stocks with excellent put returns that you might want to consider if you're in the market for selling puts. All right, let's get it. So as we discussed in the last episode, we were looking at ticker symbol LABU, and we wanted to sell a put contract at the $650 price to receive a 13-cent premium per share. But what happened was that we received an 18-cent per share premium, and if we multiply that by 100 units, which is the typical number of units in a put contract, we received $18 in total. If we back out the fee that our broker, Tastyworks in this case, deducts, which is 13 cents per contract, we were left with a $17.87 payout on the contract that we sold. And so what it means is that we have fronted $650 for 100 units of ticker symbol LABU, and for fronting this $650, we've committed to buying 100 units of ticker symbol LABU by close of play today if the price of LABU is trading below $6.50 by close of play today. If, however, ticker symbol LABU is trading above the $650 mark, then the contract will expire worthless because it will not make any sense for the owner of those 100 units of shares who bought the contract that we sold, for them to exercise their right to sell those shares to us at $6.50 when they can get a higher price in the open market. But by way of analysis, when we look at the $17.87 premium that we receive for fronting this $650 collateral to buy ticker symbol LABU, this translates into a 2.75% return over a 10-day period. And if you annualize that, you would be looking at doubling your collateral over a 365-day period, which means that if we keep making 2.75% return every 10 days, by the end of 1 year, we will go from $650 to $1,302.26. That, my friends, is not a bad way to be in the market. Of course, this is just a projection. It doesn't mean that this is what will happen every 10-day cycle, as we will see in subsequent sections of this video. So today is the 3rd of March. As you can see, this is pre-market, and ticker symbol LABU closed at the $6.46 point yesterday. After hours, ticker symbol LABU is trading at $6.53, which is higher than the $6.50 mark that we sold the contract. Now let's quickly look at what could happen at the end of play today. Remember, what we did was we sold a put contract with the strike price of $6.50 that would expire today, the 3rd of March. And there are 2 possible scenarios when you sell a put contract. The first scenario is the price of the underlying asset, LABU in this case, stays above the strike price of the put contract that you sold, which is $650 in this case. If that happens, like we mentioned earlier in the video, the contract will expire worthless because it does not make sense for the buyer of that put contract to exercise their right to sell 100 units of the underlying asset to you at the strike price if they can sell those assets in the open market for a higher price. The flip side to that coin is that the price of the underlying asset is below the strike price that was agreed at the commencement of the put contract, in which case the buyer of that contract does have a right to sell those shares to you at the higher than market strike price that you've committed to, and you then are forced to buy those shares at that strike price. Now, as we can see here with ticker symbol LABU, it is possible that ticker symbol LABU could end up being above or below the $650 mark. If it ends up being above the $650 mark, then the contract will expire worthless and we will keep the $18 premium less the fees that we paid. If it ends up being below the $650 mark, we have to buy those shares at $650. Now, is that a bad thing? Well, as we will see now, not necessarily. So let's go to the options chain for ticker symbol LABU. And if we go into the March 17 options chain, assuming we do get assigned at, let's say, $6.46, which means we have to pay $650 for 100 units of the shares, we can actually sell a covered call that will expire on the 17th of March 2023 for $650, and we could potentially get 47 cents per share, which would translate to an income of $47 less fees. And so if you calculate $47 by $650, that's a 7% return in another 10 days. And if at the end of that period, ticker symbol LABU is trading below the $650 mark, our contract will expire worthless. And if it is trading above the $650 mark, the buyer of the covered call contract will exercise their right to buy those shares from us at $650. But again, that's not a bad place to be, because remember, we have sold a put contract to earn some income before we were assigned, and we sold a call contract to also earn some income, and that means potentially we could be making more than 10% returns in less than a 1 month period on these two contracts and exiting the trade altogether. So you see the value of the whale strategy here, and the whale strategy is simply selling a put contract at a strike price that you would not mind owning the underlying asset, and if you get assigned, you start selling call contracts to generate income until you get assigned and you have to sell the underlying asset at your desired strike price. Now let's take a look at the 5 other stocks that we promised you at the beginning of this video that have put contract strike price and premiums that are worth looking at. The first one that we will look at is ticker symbol IQ, which is an entertainment company that is a subsidiary of the Baidu group based in China. If you look at the charts for IQ, they are on an upward trend and they've been consolidating at the $7 mark. And so if you go into the options chain, and let's say we go into the 17th of March 2023 options chain, you will see here that even though ticker symbol IQ is trading at $7.41, the $7 strike is going for about 30 cents per share, which translates to a 4.2% return on capital deployed for a 10-day period. That is not bad. Another one that we want to look at is ticker symbol AI. And for all who have been following ChatGPT, you will recognize that there's a lot of excitement with artificial intelligence at the moment. Again, if we look at the charts here for ticker symbol AI, it rose quickly to the $27 mark. It's come back down and seems to be finding resistance at the $20 mark. And so if we go into the options chain and we search the March 17 contract or options chain contract, and let's scroll down. If we look at the $20 mark, we can sell a put that will expire in 10 days time for $20 and receive a premium of about $1.45, and this translates into another 7.25% return on a $2,000 collateral. A third asset that we think you want to look at is ticker symbol FUBO. And it's interesting here, ticker symbol FUBO has been trading above the $2 mark. Yes, it seems to be trending down at the moment, so this is one to be careful about. But one can also say it's been oscillating sideways between the $1.5 and the $2.5 mark. Now, even though ticker symbol FUBO is trading below the $2 mark, if we go into the March 17, 2023 options contract, we see here that for the $2 contract, or maybe even the $1.5 contract, we're looking at a $0.9 or 9 cents premium on the $1.5 contract. And what does that translate to? That translates to a 6% return on a $150 collateral for 100 units of ticker symbol FUBO. Again, not bad for a 10-day contract period. Another ticker symbol that we could look at is ticker symbol ESPR. And this is a pharmaceutical company. ESPR, when we look at the charts, has been oscillating between the $5 mark and the $7.50 mark. And so if we go into the options chain for ticker symbol ESPR, the next expiration is the 17th of March. And let's say we want to sell to be on the safe side, the $5 put, we will potentially receive 35 cents per contract, and this translates into a 7% return on a $500 collateral in less than 2 weeks. And the last one, another very interesting one, is ticker symbol VRM. And they pronounce Vroom. I didn't know there was a company called Vroom until I saw this ticker symbol. But Vroom, or ticker symbol BRM, has been oscillating just around the $1 mark. And so we can say we want to sell the $1 put that will expire on the 17th. And for that $1 put, we could potentially receive 12 cents per share, which would translate to $12, which is easily a 12% return within a 2-week period. So these are 5 potential put contracts that one could consider. Again, none of this should be considered as financial advice, but these are potential put contracts that highlight the value of using puts, cash secured puts, as an opportunity or a tool to generate income for yourself while you wait to buy stocks that you like at your desired strike price. So we hope you enjoyed today's episode. about how you can use cash secured put as a way to grow a small portfolio. If you enjoyed what you saw and you haven't done so already, please hit that subscribe button. And while you're at it, do hit the notification bell. And if you know anyone who will benefit from watching this video, please share this video on your social media feed. You might be helping someone who's looking to generate some passive income for themselves. And of course, you want to check us out on Twitter, Instagram, and on TikTok. Links to the other social media channels will be left in the description section below. If you've got a question, please leave that in the comment section and we'll be sure to respond. Look out for the next episode where we will see what was the outcome of the put contract that we sold and what is the next trade that we will execute as we grow this small portfolio to become a big time portfolio. See you in the next episode.